Welcome back to the deep dive. If you've ever had to, enroll in a benefits plan, you know that healthcare finance seems to operate under this deliberate fog of confusing terminology.
It really does.
We're talking about the maze of deductibles, copayments, coinsurance, and that bewildering alphabet soup of tax accounts, HSA, FSA, HRA.
Right.
It feels less like an organized system and more like a high-stakes scavenger hunt for your own money.
It absolutely feels that way, but the reality is that these specific terms, while, people often use them interchangeably in just casual conversation, each one dictates a really unique mechanism for how and when and where money leaves your pocket for health services.
Okay, so our mission today is to cut through that.
Exactly. Our mission today is a targeted deep dive into the detailed financial sources you shared, cutting through the confusion to provide a definitive, clear map of these systems.
And the goal.
We want you to walk away understanding not just what these things are, but, how they are intended to operate and why they were designed that way in the first place.
Okay, let's unpack this by establishing the fundamental concept first. We often hear the word coinsurance used broadly in finance. Before we narrow it down to the healthcare context, what is the foundation of coinsurance?
So at its foundation, coinsurance is simply the general concept of splitting or spreading financial risk among multiple parties.
Just spreading it out.
It's a mechanism of risk distribution. In the specific context of the U.S. insurance market, it means the joint assumption of risk and liability between the insurer and the insured party. It's the idea that neither party carries the entire financial burden alone.
That makes sense. It's fundamentally shared risk. But when we look at an actual benefit statement, we see three distinct terms that are constantly mixed up and whose sequence really defines our out-of-pocket costs. When we drill down into U.S. health insurance, what are the three core cost-sharing mechanisms we need to clearly define?
The three terms that are essential for the listener to keep separate are the deductible, the copayment, and then coinsurance itself, used in a very specific, narrow sense.
Let's get those definitions locked in right now. When we talk about the deductible, what is its primary function? When does it kick in?
The deductible is the gatekeeper. It is the fixed dollar amount you, the insured, pay out of pocket first.
So nothing happens until that's paid.
Exactly. It's a mandatory threshold that must be completely satisfied before the insurance provider pays any significant covered expenses beyond, usually basic preventative care.
Fixed amount first. Okay. How about the copayment?
A copayment, or a copay, is the fixed dollar amount paid for a specific service each time you access it.
Every single time?
Every time. Think of it as a flat fee transaction cost, whether it's $20 for a routine doctor's visit or, say, $75 for an emergency room visit.
And finally, that specific health insurance term, coinsurance. How does it fit into the payment timeline relative to the other two?
So coinsurance is the percentage split. It is triggered only after you have satisfied your initial deductible.
After the gatekeepers.
Right. You pay this percentage of the remaining allowed medical costs, and this sharing continues until you hit your policy's stop-loss limit, which is your out-of-pocket maximum.
And once you hit that stop-loss?
The insurer then assumes 100% of all additional covered medical costs for that plan year.
That sequence deductible first, coinsurance percentage second, and then copays existing throughout as these fixed transaction fees, that is the absolute foundation for navigating this entire system.
It is.
Now, let's dive into the mechanics of the deductible, because that is the mechanism that determines the true front-end cost of an insurance plan.
The deductible carries significant weight because it is the primary threshold that separates, everyday spending from catastrophic coverage. Insurers rely on this mechanism heavily, and it serves three primary strategic purposes for them beyond just the simple mathematical reduction in their payout.
Okay, so what are those strategic drivers that make the deductible so important to the insurer's model?
The first is just direct liability reduction. By forcing the insured to bear that initial cost, which in modern plans can be thousands or even tens of thousands of dollars, the plan reduces its overall financial liability directly.
Simple enough. What's the second?
The second strategic driver, and this is especially critical in high-deductible health plans or HDHPs, is behavioral. Deductibles are fundamentally intended to disincentivize unnecessary or frivolous claims.
That concept of moral hazard, the idea that people overuse a service when they don't bear the full cost.
Precisely. If you are enrolled in a plan where you know you have to clear a $6,000 hurdle out of pocket, you are far less likely to seek minor unnecessary care because you are effectively paying the full negotiated rate for those initial services.
So the hope is that you become a more responsible, cost-conscious consumer.
That's the expectation, yes.
And the third driver focuses on the scope of the insurer's focus.
It's about restricting the insurer's liability to only significant, potentially catastrophic events. By shifting the financial burden of small, routine claims, the minor illnesses, the routine tests away from the plan, the insurer dramatically reduces its administrative load.
And that lets them concentrate their resources.
Exactly. They can concentrate their massive resources purely on handling and mitigating the largest claims where the insured is truly exposed to financial ruin. This strategic removal of small claims allows the insurer to achieve higher overall savings and price the policy more competitively.
This strategic choice leads directly to the classic insurance trade-off: premiums versus deductibles.
Right.
Our source material gives us some excellent real-world numbers illustrating that necessary inverse relationship.
It's the core equation of insurance design. You have to choose where you want the cost burden to fall. You can opt for a high monthly premium for the comfort of a low deductible, or a low monthly premium but accept a high deductible.
So what were the numbers in that comparison?
We saw a stark comparison in the material. One plan had a relatively high monthly premium of $1,087. This plan offered a $6,000 deductible.
Which means your ongoing monthly drain is high, but your catastrophic ceiling is relatively contained.
Exactly. Now compare that with a competitive plan that offered a significantly lower premium, $877 a month. The annual savings are substantial, but that plan came with a massive required deductible of $12,700.
Wow.
The trade-off is clear. You save $2,100 annually on premiums, but you are personally liable for more than twice the upfront cost before the insurance really kicks in.
So that lower premium is your financial wager that you will not require major care.
That's a perfect way to put it. You're betting on your health.
That puts the choice into sharp relief for the listener. Now, we touched on how deductibles are applied, and it changes depending on the type of insurance, which is an important clarification point.
It does. In health and travel insurance, deductibles are typically term-based, meaning they reset annually.
Every year, back to zero.
Right. And this structure is necessary because medical treatment for a single diagnosis often spans multiple visits, months, or even years. So applying it per visit would render the coverage, well, useless. It's an annual reset regardless of how many covered events occur.
But that structure changes entirely in property and automobile insurance.
Here, the deductible is often applied per covered incident. If you total your car today, you pay the deductible. If you have another covered separate accident 6 months from now, you pay the deductible again.
Okay, that makes sense.
And what's more, in property insurance, a single policy might delineate completely separate deductible amounts based on the cause of the claim. You might have a lower fixed dollar deductible for theft, but a substantially higher percentage deductible specifically reserved for catastrophic events like a windstorm or an earthquake.
So the deductible acts as a risk modifier tailored to the specific high-exposure risk involved.
That's exactly right.
Let's clarify some insurance jargon now that sounds like a deductible but functions profoundly differently. We need to define the difference between a deductible and something called a franchise.
Yes. This is a subtle yet profound difference in risk dynamics that listeners must understand. A deductible means the policyholder always pays a fixed amount, and the insurer pays the rest. It is a shared liability.
Okay.
A franchise, however, is a pure threshold. If a claim falls short of that franchise threshold, the policyholder is financially liable for the entire amount.
The whole thing. Can you give us an example using specific numbers?
Certainly. If you have a franchise set at $20,000 and your claim for loss comes in at $19,900, the policyholder pays the entire $19,900, the insurer pays zero.
Wow.
But if that claim is $20,100, the full liability for that $20,100 is transferred to the insurer.
The whole amount, not just the amount over the threshold.
The entire thing. The franchise is a line in the sand. The insurer is saying, we only engage if the loss is catastrophic. It shifts the risk burden completely between the two parties based on where the claim falls.
That makes the choice between those two systems extremely high stakes for the policyholder. We also need to dedicate some time to the major administrative complexity that arises with third-party deductibles found in liability coverages like auto liability or workers' compensation.
These are known as third-party deductibles, and they are notoriously complex because the money flows are, well, convoluted. The insured is paying a portion of the claimant's loss.
Of someone else's loss.
Yes. When a covered liability event occurs, the insurer has a legal and contractual obligation to immediately pay the claimant the full covered amount to settle the loss quickly.
So the insurer covers the third-party loss right away, including the portion that is technically owed by their own customer.
Correct. But by doing so, that payment automatically creates a receivable and amount owed back from the insured to the insurer equal to the deductible amount stipulated in the policy.
And the sources note that this process is such an administrative nightmare that millions of dollars frequently go uncollected by insurers.
It's a huge problem.
Why does this massive internal administrative leak happen?
It stems from a combination of systemic issues and poor coordination. First, the event triggering the receivable is usually a massive stressful incident, a serious accident, a lawsuit meaning the insured is distracted, dealing with the human and legal fallout.
And the second reason?
The insurer's internal systems are designed to prioritize complex claims adjudication over collecting small receivables from their own clients. The claims departments and the billing or accounts receivable departments are often completely siloed, leading to a breakdown in billing communication.
And the timing is bad too, I'd imagine.
The timing is very difficult. The insurer pays the claim immediately, but the policyholder may not be billed until months later after the crisis has passed, making the collection effort feel punitive and much harder to enforce legally.
So the system prioritizes the rapid closure of the third-party claim, but in doing so creates a massive internal chasing problem. The insurer has to chase their own customer to collect the money they already paid out on their behalf.
That's a perfect summary of the problem.
Okay, let's move on to coinsurance in the health context. Let's reestablish its position in the cost-sharing timeline.
It starts only after the deductible, the gatekeeper, is met. This is the period of percentage-based joint liability.
And this percentage split continues until the insured hits the maximum safety net, the stop-loss.
Correct. We see common insured percentages like 70-30, 80-20, or 90-10. The first number is always the insurer's share. Once you reach the stop loss, which typically ranges from about $1,000 to $3,000 in additional costs beyond the deductible, the insurer then assumes 100% of any additional covered medical costs for that plan year.
So the stop loss is the contractual firewall against financial ruin from a catastrophic medical event.
It is. It's the ultimate protection.
That distinction, the stop loss limit, is the safety net that is specific to health. But as we discussed earlier, the word coinsurance is also used in completely different contexts, like property and title insurance, where it actually functions as a punitive tool rather than the safety net.
It's an amazing functional transformation. In property insurance, coinsurance operates as a penalty for underinsuring the value of your tangible property.
A penalty.
Yes. The insurer includes a coinsurance clause, often requiring the property to be insured for at least 80 or 90% of its replacement value, to prevent policyholders from saving money on premiums by reporting an artificially low asset value.
And if they fail that test, if they underinsure,
if the policyholder files a claim for a loss, and the insurer determines the property was significantly underinsured according to the clause, the insurer imposes a penalty. The payout is reduced, and the policyholder has to share the loss based on the percentage they should have insured versus the amount they actually did insure.
So it forces policyholders into compliance regarding accurate asset valuation.
Exactly.
That shifts the risk dynamic completely, from splitting a cost you didn't foresee to penalizing you for an intentional decision to underinsure. And title insurance takes this complexity to another level entirely.
It really does. Title insurance, particularly using the older American Land Title Association, ALTA, forms from 1987 to late 2006, outlines two very specific scenarios where the insured retains a percentage of the risk for partial losses.
And the first one is similar to property insurance.
The first, again, is if the insured failed to insure their title for at least 80% of its market value when the policy was issued, the insurer only pays 80% of any partial loss.
Okay, that makes sense. But the second scenario involves property improvements, and the formula required to calculate the retained risk is notoriously complex.
It is arguably one of the most complex formula in insurance law, and it is specifically designed to prevent the policyholder from receiving an undue windfall following significant uninsured property improvements.
So if you build a huge addition on your house but don't update your title insurance.
Precisely. If post-policy improvements increase the property value by 20% or more above the original policy amount, this coinsurance formula kicks in.
Let's attempt to articulate that ratio because it highlights the level of legal nuance.
Okay, so the insurer pays a percentage of the claim equal to 120% of the amount of insurance purchased, divided by the sum of the original amount of insurance and the cost of the new improvements.
I see why they call it complex.
In short, it artificially deflates the effective coverage percentage to reflect the fact that the massive spike in property value was never underwritten or charged a premium for by the title company. It's a mechanism to manage unexpected surges in insurable value after the policy is written.
The variation in the definition of coinsurance is truly staggering. From a healthcare safety net to a property penalty to a complex legal ratio governing title changes.
It's all about context.
Before we move on, how does this percentage apply to business interruption coverage?
In business income interruption insurance, which is a form of time element coverage, the coinsurance percentage actually indicates the duration of coverage the business is eligible for. It relates to the estimated time needed to resume normal operations.
So a higher percentage means more time?
Exactly. For example, a 50% coinsurance might allow for 6 months of coverage, whereas a much higher 125% coinsurance allows for 15 months of coverage. It functions as a durational metric, letting the business select its required recovery timeline.
Let's move to the most frequent cost-sharing payment the consumer makes, the copay. This is the fixed dollar amount paid directly to the provider.
That direct payment to the provider is the norm, but we must note the specific administrative exception for Medicare Part D patients enrolled in the Medicare Prescriptions Payment Plan.
What's changing for them?
Well, starting January 1st, 2025, they will see their copayments handled indirectly through their insurance company rather than paying the pharmacy directly.
Now, let's go back to the distinction that trips up so many people trying to hit their out-of-pocket maximums. Why is it so crucial to remember that copayments are typically treated differently than deductible and coinsurance payments?
Because copayments generally do not contribute toward that policy's out-of-pocket maximum or stop loss.
At all.
Generally not. You could spend hundreds or thousands of dollars in copayments for routine visits and prescriptions, and you may find that none of that money helps you reach the ceiling where the insurer takes over 100% of costs.
But deductible and coinsurance payments do.
They do. Deductible payments and coinsurance payments do count. Copays often do not.
That makes calculating your annual liability extremely difficult for the average consumer. What is the intent behind the insurer using copays if they don't count toward the limit?
The intent is twofold, and it's rooted in utilization management. Insurers use copayments to share costs, but primarily to prevent that moral hazard we keep returning to. By placing a small, fixed financial barrier, say $20, they aim to deter people from seeking non-essential medical care, reducing overutilization and the administrative processing of small claims.
And in some non-U.S. systems, they can also serve to regulate access.
Exactly. In systems that rely on waiting lists for non-emergency care, copayments can serve as a regulator to reduce the welfare cost associated with those long waiting periods. By tempering demand, they theoretically allow the system to respond more quickly to high-priority cases.
That is the theory. But let's examine the serious unintended consequences, the dark side of cost sharing that researchers have consistently documented.
The observation is stark. Higher copayments are strongly associated with reduced use of necessary medical care. Research has shown that these high financial barriers lead to lower rates of drug treatment adherence, worse adherence among existing users, and more frequent discontinuation of therapy.
And this is particularly problematic for chronic conditions. The sources specifically mention chronic heart failure, breast cancer, chronic obstructive pulmonary disease, and asthma. For these conditions, avoiding a low-cost copay for a daily drug can quickly spiral into a high-cost emergency event.
It creates a perverse and expensive public health incentive. You save the small copay on the preventive measure, but you incur massive costs for the subsequent emergency room visit or hospitalization that was entirely avoidable.
So this mechanism undermines long-term health goals for short-term utilization control.
That's the core conflict.
This issue is often magnified in the context of prescription drugs, where the cost differential between generic and brand-name drugs is managed via the copay structure.
Right. Insurers deliberately set the copay for non-generic or brand-name drugs higher than for generics to incentivize the use of cheaper, effective alternatives. However, pharmaceutical companies actively try to disrupt this steering mechanism.
How do they do that?
By offering drug coupons or temporary subsidized copayment reduction programs, which typically last anywhere from 2 to 12 months.
And those temporary subsidies are designed to achieve patient lock-in to the high-cost brand.
Yes, the patient uses the drug coupon, pays the minimal copay, and gets accustomed to the brand name medication. Once that temporary subsidy expires, the patient is suddenly faced with the full high copay.
And if they have a serious chronic condition and no similar effective generic is available.
They're locked into paying the high cost or suffering the consequences of non-adherence. It's a calculated marketing strategy used to maintain high patient loyalty and revenue.
To wrap up our discussion on copayments, let's look one last time at the German national experiment from the late 1990s, where they used copayments to curb utilization on a systemic level.
Germany introduced comprehensive copayment rules specifically to control costs and utilization in their statutory health insurance. They did implement protections for the vulnerable, chronically ill members, had an annual gross income limit of 1% for copayments, including dependents.
But what was the result?
Well, despite these efforts and other administrative changes that reduced average hospital stays, research studies ultimately showed that the copayment system was simply ineffective in reducing doctor visits and overall utilization.
A major, expensive experiment that failed its core behavioral purpose.
Yes, the system was found to be administratively complex and failed to meaningfully change behavior without damaging access to care. So in the end, the Bundestag voted the copayment system out entirely in 2012.
Which provides strong international evidence against relying on minor fixed financial barriers for broad utilization control.
Very strong evidence.
They've broken down the three core mechanisms used to share costs. Now we shift gears to the instruments designed to help the consumer pay those costs using pre-tax dollars. This is where the alphabet soup gets serious. We are starting with the most celebrated and complex, the Health Savings Account, or HSA.
The HSA is unique because it masterfully combines health spending with aggressive investment and retirement planning. But we must reiterate the foundational role.
The big one.
HSAs are available only to taxpayers enrolled in a high-deductible health plan, HDHP. That pairing is a strict requirement.
And the primary reason for their popularity, often driving high-income consumers toward HDHPs, is the legendary triple tax advantage. Let's detail each of those three layers.
Okay, layer one. Tax-free contributions. Contributions made by the employee via payroll deduction are pre-tax, and contributions made directly by the individual are tax-deductible, shielding that income from federal taxes at the time of deposit.
Layer two, tax-free growth.
The funds roll over and accumulate year to year, entirely sheltered from taxation. Unlike almost any other tax-advantaged account, the investment earnings, so interest, dividends, capital gains, are not subject to current taxation. This makes long-term compounding exceptionally powerful.
And layer three, tax-free withdrawal.
Any withdrawals made for qualified medical expenses at any point in the participant's life are entirely tax-free. Tax-free in, tax-free growth, tax-free out, provided the funds are used for health expenses. That level of sheltering is just unmatched.
The ownership structure is also key, differentiating it from an employer-controlled account like an HRA.
Right. HSAs are owned by the individual. They are completely portable. Even if the policyholder loses their job, changes careers, or switches to a non-HDHP plan, the money already deposited remains theirs, always available for tax-free withdrawals for qualified expenses.
But they can't add more money.
They simply lose the ability to make further deposits without active HDHP enrollment.
This portability and tax-sheltered growth allow the HSA to transition into a powerful investment vehicle, often dubbed the ultimate retirement account.
Because the funds are protected from taxation, they can be actively invested similarly to an IRA in stocks, bonds, mutual funds, and other growth assets. And the key strategy this enables is self-reimbursement, which is where the long-term tax benefit is truly maximized.
Explain the self-reimbursement strategy because it requires massive discipline, but maximizes the tax benefit decades later.
Okay, so the strategy dictates that the participant pays their current medical costs, copays, deductibles, glasses, etc., out of their own pocket rather than using the HSA.
Not using the HSA money at all for current expenses.
Right. They must meticulously retain every single receipt from that point onward. They allow the money in their HSA to grow, completely untouched, for years or even decades, maximizing the power of tax-free compounding returns.
So the HSA balance swells over time. When do they finally withdraw the money?
Later in life, when they need a large untaxed lump sum of cash, perhaps for something non-medical. They can withdraw funds out of the HSA up to the value of those decades-old retained receipts, entirely tax-free.
And there's no time limit.
The IRS places no deadline on when you must reimburse yourself for expenses incurred after the HSA was established.
That is essentially converting initial pre-tax income into tax-free retirement income decades later, provided you had the liquidity and discipline to pay for current health costs out of pocket initially.
It's a crucial tool for financial strategists. Let's cover the contribution and withdrawal rules. The contribution limits are indexed annually by the IRS.
For 2025, the limits are $4,300 for a single person and $8,550 for families.
And for participants aged 55 or over, there is an additional $1,000 catch-up contribution available. It's important to remember that all funds contributed, whether by the employer or the employee, count toward that single annual maximum.
Now, if a participant withdraws the money for a non-medical expense before reaching age 65, what penalties do they incur?
That withdrawal is subjected to two significant financial hits. It is immediately taxed as ordinary income, plus a steeped 20% penalty. This penalty is the IRS's method of ensuring the account maintains its health-focused purpose.
But that 20% penalty disappears once the person reaches 65 or becomes disabled.
Correct. At that point, non-medical withdrawals are only subject to income tax. This allows the HSA to fully transition into functioning like a traditional tax-deferred IRA, but with the added benefit of maintaining its triple tax-free status for any future qualified medical expenses.
We should also clarify the rules around using HSA funds for insurance premiums, which are generally not eligible.
Right. Insurance premiums are generally not HSA eligible, with specific exceptions designed for vulnerable populations. COBRA continuation premiums, premiums paid while receiving unemployment compensation, certain Medicare expenses, or age-based limits on long-term care premiums are permissible. Otherwise, the HSA cannot be used to pay your monthly insurance bill.
To put the growth of this system into context, the HSA model replaced the older medical savings accounts in 2003. The market today is colossal.
The adoption has been exponential, driven by the shift toward HDHPs. As of the 2025 data points cited in the sources, there is an estimated $159 billion being held across 40 million health savings accounts.
That's incredible.
It has matured from a niche concept to a dominant, influential component of the financial services and health sectors.
Let's switch gears to the FSA, the flexible spending account. These accounts are generally simpler, offered even with traditional health plans, and are commonly used to cover the deductibles, copayments, and co-insurance payments we detailed earlier. But the biggest drawback, and the reason they cause so much year-end panic, is the use it or lose it rule.
That rule is the primary disadvantage. Any funds left unspent at the end of the coverage period are typically forfeited back to the employer. This forfeiture mechanism historically resulted in employees rushing out to buy huge inventories of supplies in December.
Right, the mad dash for Band-Aids. Fortunately, the IRS has allowed employers to mitigate this strict rule, though they can only choose one of the two options.
That's right. The employer can permit either a grace period of up to 2.5 months after the plan year ends to use the funds, or they can allow a carryover amount into the next plan year.
And that carryover is $660 as of 2025.
Correct. But they cannot offer both the grace period and the carryover simultaneously for the same plan year. It's one or the other.
Let's discuss the funding mechanism, specifically for medical FSAs, which introduces a definite risk for the employer: pre-funding.
With a medical FSA, the entire annual contribution amount the employee elected is made available on day one of the plan year, even if they haven't contributed that full amount yet via payroll deductions.
So it's front-loaded.
It is, and that pre-funding is an employee benefit.
So if an employee utilizes the full annual amount immediately and then separates from the company, they do not have to repay the difference. That is a direct, realized risk for the employer.
It is, but it's often offset. The employer benefits from the forfeited funds of other employees, which can be substantial, estimated up to 14% of total employee contributions, which helps cover the risk incurred by the pre-funding rule.
And there are tax savings for the employer, too.
Yes, the tax savings the employer realizes from reduced payroll taxes for all participating employees is often much greater than the administrative fees or occasional pre-funding losses.
FSAs aren't just for medical expenses. We have different types, most notably the Dependent Care FSA.
The dependent care FSA is critical for working guardians. It is used to cover expenses like daycare, summer camps, or elder care costs that allow the guardian to work.
And the limit on that is going up.
It is. The federal limit is currently $5,000 per household, but that is increasing significantly to $7,500 per year as of January 1st, 2026.
And the dependent care FSA has a critical funding difference compared to the medical FSA.
Yes, the dependent care FSA is not pre-funded. Employees are only reimbursed up to the amount they have already contributed so far during the plan year. This completely removes the risk of an employee overdrawing the account and leaving the job, minimizing the employer's liability.
One of the most confusing regulatory aspects of FSAs has been the constant change in eligibility for over-the-counter drugs. We need to trace that regulatory history.
It was a chaotic journey. OTC drugs were initially eligible in 2003. They became ineligible without a doctor's prescription in 2011 following the Affordable Care Act. This created massive friction for consumers and providers.
A huge headache.
It was. Then, effective January 1st, 2020, thanks to the CARES Act, OTC drugs, along with menstrual care products, became eligible again without requiring a prescription, restoring their status and broadening the available spending categories.
And to manage that constantly shifting list of eligible items at the register, there's a technological solution required for compliance.
That is the IIAS, the Inventory Information Approval System. This specialized technology is mandated for most merchants accepting FSA debit cards. It references a master eligibility list and automatically distinguishes eligible health items from ineligible items right at the point of sale.
So it does the sorting for you.
Exactly. It ensures compliance and provides automatic verification for the debit card transactions.
Finally, a quick note on a specific state requirement aimed at protecting employees from that use-it-or-lose-it panic.
Employers in California sponsoring FSAs are required by state law to notify participants working in California of the deadline to withdraw their funds. This notice must be sent using at least 2 different methods, and only one of those methods is allowed to be electronic.
So they're really trying to make sure people know.
It's a legislative attempt to force clear communication about fund deadlines.
Finally, the Health Reimbursement Arrangement, or HRA. This one is often the most opaque because it isn't truly an account in the typical sense of segregated, trust-protected funds.
That's the key legal distinction. An HRA is not a true account. It's an employer-funded plan or agreement, a contract, to reimburse employees for out-of-pocket medical expenses and, in certain modern variations, for insurance premiums.
And unlike the FSA and HSA, the funding rules here are strict and one-sided. No employee contribution allowed.
HRAs must be funded solely by the employer. Employee salary deductions are prohibited. This structure means that if an employee separates from the company, any unused dollars remain with the employer.
They don't follow the employee.
They do not. That's a major difference from the HSA.
Post-ACA, these HRAs also have rules about integration with group plans.
They must be integrated with a qualified employer-sponsored group health plan to avoid stiff excise tax penalties. The advantage for both parties is significant. Reimbursements for qualified medical expenses are tax-free for the employee and tax-deductible for the employer.
And the funds can roll over.
Crucially, yes. Unused funds can typically be rolled into future years, which is an advantage over the traditional FSA model.
The sources outline a few growing variations of the HRA aimed at increasing flexibility for employers.
Yes. For small employers, there's the QSEHRA, or Qualified Small Employer HRA, established in 2016. It allows them to pay for individual market premiums for their employees instead of being forced to offer a traditional group plan.
And that's subject to IRS caps.
It is, such as $58.50 for self-only coverage in 2023.
And the newest, most flexible model is the ICHRA, which is driving enormous recent growth in the HRA space.
The ICHRA Individual Coverage HRA became available in January 2020 and is open to businesses of all sizes. It allows employers to set monthly allowances and reimburse employees for their individual insurance premiums and medical expenses. The growth has been rapid, increasing 350% from 2020 to 2022.
Why so much growth?
Primarily because it allows employers to scale benefits across 9 different employee classes. It's very flexible.
But there is a very important regulatory restriction on offering the ICHRA.
An employer cannot offer employees in the same classification a choice between the ICHRA benefit and traditional group health insurance. It has to be one or the other for a given class of employees.
And why is that?
This rule is designed to prevent adverse selection within the employer's plan pool.
Despite the recent popularity, the HRA comes with a lot of complaints regarding its administrative burden and complexity. Let's dive into the compliance alphabet soup.
HRAs are highly regulated and must comply with a dense array of federal rules designed for comprehensive health plans. This includes COBRA rules regarding coverage continuation, ERISA rules regarding plan funding and fiduciary duty, and HIPAA rules regarding privacy and security.
That seems like an enormous administrative burden, especially for a small business offering a QSE or ASHRA.
It is. They're also subject to Medicare secondary payer reporting requirements, which create significant administrative burdens and potential penalties for noncompliance. Navigating this web of complex requirements makes the HRA model very challenging to administer.
And it doesn't work for everyone.
Right. Self-employed persons and owners of S corporations are typically ineligible unless they legally employ a spouse, severely limiting the utility of the program for sole proprietors.
We've built the map of the mechanics and the funding instruments. Now we move to the philosophical battlefield. Why these high-deductible systems paired with HSAs were created and what the real-world impact is. This brings us to the core philosophy of consumer-driven healthcare.
Proponents view the HDH-PHSA model as a necessary financial reform intended to reduce systemic cost growth and increase system efficiency across the board. The core belief is that healthcare costs spiral out of control because consumers are currently too insulated from the true costs by traditional low-deductible plans.
So the patient is essentially being forced to become a rational economic actor, a smart shopper in the healthcare marketplace.
Exactly. This model is supposed to accomplish several things: encouraging saving for future healthcare expenses, allowing the patient to receive needed care without a bureaucratic gatekeeper, maximizing personal choice, and fundamentally making consumers more responsible for their own health choices by directly linking costs to their bank accounts via the deductible.
And the expected market behavior change is that high deductibles will push consumers to actively seek out and choose lower-cost options.
That's the theory. The thinking is that if you know you're paying the first $12,000 yourself, you will diligently shop for MRI prices, choose generic drugs, and be vigilant against excess and fraud in the industry. The model aims to achieve systemic efficiency through consumer prudence.
That is the compelling argument for market efficiency. But critics argue that this efficiency comes at a cost, benefiting the wealthy and creating major equity concerns. What are the major criticisms of the HSA-HDHP model in practice?
The primary criticism centers on the fact that the system disproportionately favors the healthy, the young, or, most critically, higher-income people, those who can afford the high deductible upfront and have the financial stability to maximize the triple tax advantage investment gains over decades.
And there's data to back that up.
Yes, the Government Accountability Office confirmed this, noting that tax filers reporting HSA activity consistently had higher average incomes than other tax filers.
And for those who aren't high income, the structure creates agonizing dilemmas that pit health against financial security.
It creates an intense conflict for families deciding whether to obtain necessary medical treatment when it drains their savings versus protecting their ability to manage future tax liability and retirement savings.
Right.
Critics argue that the tax breaks offered by the HSA are too modest to persuade low-income individuals to buy coverage when they are faced with a potentially massive high deductible that could wipe out their savings.
And there's the concern that this model reduces the inherent social redistributive element of insurance.
By heavily incentivizing healthy, financially secure people to choose investment-focused HDHPs, it potentially skews the risk pool. The pool of traditional full coverage plans is then left with a disproportionately higher number of sicker or older patients, which inevitably drives up premiums for everyone who remains in those traditional plans.
There's also the inherent financial risk tied to the investment nature of the HSA itself.
If participants follow the aggressive investment strategy moving funds into stocks or other market instruments, they must accept that those funds are not FDIC insured and are subject to market risk and potential capital loss.
Which is a big deal.
For individuals who need stability and quick access to their emergency medical funds, this market exposure makes the investment-focused HSA a significantly risky option.
This highlights the philosophical split. Is the HSA a retirement strategy or a health crisis fund? And the user's answer determines their entire financial path.
That's the core question.
This philosophical debate leads directly into the real-world results regarding patient satisfaction and behavior. And the results are complex and often contradictory.
In the early years, some reports showed high satisfaction. For example, a 2005 survey by the Blue Cross Blue Shield Association found widespread satisfaction. However, the more comprehensive long-term studies that followed painted a more concerning picture regarding comfort and comprehension.
What did those later surveys find?
Later surveys, such as those from Towers Perrin and the Commonwealth Fund, found that employees in high-deductible plans were significantly less satisfied with their plan's elements. They were less comfortable with the level of financial risk and often struggled to understand the mechanics of the plan or how to use their associated accounts effectively.
But the most concerning finding relates directly to access problems, linking back to the unintended consequences of cost sharing.
The research is consistent. Participants in high-deductible plans, especially those with poorer health status or lower incomes, are far more likely to delay or entirely avoid getting needed care or to skip medications because of that initial cost barrier. They delay low-cost interventions because they cannot afford the high-deductible payment.
So the efficiency mechanism is actively undermining necessary care. And if the system is built on consumers acting as informed shoppers, how much price and quality information do they actually have?
Very little. A general finding across multiple studies highlights a massive information deficiency. Few Americans in any health plan, only about 12 to 16% of insured adults, have the necessary information about the quality or cost of care provided by their doctors and hospitals needed to make informed, consumer-driven decisions.
So the system requires that you shop, but the prices and quality metrics are intentionally hidden or simply unavailable. That creates a huge fundamental gap between the theory of consumer-driven healthcare and the patient's reality in the marketplace.
A huge gap, yes.
We've covered a vast amount of complex territory today. To recap the core distinctions.
The deductible is the fixed amount you pay first. The copay is the fixed transaction fee you pay for access. And coinsurance is the percentage split that kicks in after the deductible is met.
And the tax advantage accounts have distinct roles. The HSA is the flexible, triple tax advantage investment vehicle that requires a high deductible health plan.
The FSA is the use it or lose it account, unless the employer permits the grace period or carryover available with traditional plans.
And the HRA is the employer-funded agreement that carries the strictest rules about funding and rolls over funds at the employer's discretion.
And the consistent policy goal across all these mechanisms is utilization control, reducing unnecessary claims by forcing the consumer to share financial risk.
But the evidence we found today profoundly complicates that policy mechanism. We saw that cost sharing, while intended to curb frivolous utilization, often ends up discouraging necessary preventative care and medication adherence, leading to worse long-term outcomes for chronic illness and systemic failure in national experiments like Germany's.
This brings us to the ultimate question for you, the learner, to consider as you navigate your next benefits choice. We have a system engineered for short-term financial efficiency, aiming to discourage frivolous utilization. Yet the evidence shows that this mechanism frequently causes patients to delay low-cost preventative measures today, like taking daily maintenance medication, which inevitably leads to high-cost emergency and catastrophic treatments tomorrow.
So the question is, how do we balance the efficiency goals of insurance providers with the public health reality that delaying necessary care now simply guarantees greater cost and suffering later? That trade-off efficiency versus necessity is where the deep dive continues.